Hey world, it's Bean coming back with another video. Coming live. Wait a couple minutes. And I was supposed to go at 8, but my computer phone, not my computer phone, my computer camera had some technical difficulties, so I'm having to come live on my phone. And so I just wanted to talk about a couple things. It's been crazy out here, family. Been crazy out here. But I had to get another camera because my camera broke on my phone, so I got to get me another camera. And so I'm coming live on my phone, so hope everybody can hear me okay and can see me okay. But not going to be on long tonight, family. I wanted to say first, thank you so much. And if you didn't get a chance to check out that video, look at Mark, MW. And I'm on my phone, so the comments come real fast, and then they leave real quick before I can read them. So hopefully I can. Jason, what's up? That's what's up. Fidelity and Vanguard. Nice. Nice. I'll tell you what, I think when the last message I got from you, you got into some index funds with Vanguard. That's good. You know, Vanguard is a good company to have index funds. Actually, they the top index fund company out there. Oh yeah, the S&P 500. Yeah, I mean, notice it's over 3,000 points now, so it's steady rising. So you know, it's gonna be interesting to see how things gonna go here pretty soon. You know, we get that money, save that money. Tonight I want to talk about something real quick because, you know, I did a video earlier today, and I was talking about politicians and talking about preachers and how they were similar, but how they don't really care about the people that vote for them or the people in the congregation, because there's a lack of education. And Jason, I'm glad you're in the house because I think we need to understand the difference between assets and liabilities. There's a big difference. I think, you know, going to school, you know, you hear about something being an asset, you hear about things being liabilities, but the true nature of what an asset and a liability is has to do with cash flow. All right? Whatever it is that you call an asset, you ask yourself the question, is my cash flow coming in or is my cash flow going out? And if I have if there's cash flow coming in, that's an asset. If cash flow is going out, that's a liability. So a lot of people think, you know, when you buy a house or cars or, you know, stuff like that, that it's an asset. It's really not an asset if you have money going out every month. You know, that's your you know, your residence. You know, but as far as an asset, it's not an asset until you actually get money coming in. Okay, and so, you know, I want to talk about that, and I want to talk about 3 sources of income. And Jason, I'm glad you're in, family. There are three kinds of income that we need to probably be thinking about. Okay, and a lot of us already have earned income, and earned income is just money that we get from our job. All right, and so our earned income is really basically a liability because as soon as we get it, we have to dish it out. Okay, so, you know, we got to really understand what's an asset and what's a liability, and so that's why we have to, in order to get wealthy, in order to, you know, to build your net worth, you have to start utilizing 3 different kinds of income. All right, because remember, your earned income, that's what we all have. You know, we all have jobs. DG, what's up? Minnesota in the house. Okay, we all have jobs. That's earned income. But when you look at that money that you're getting from that job, remember, family, unless you get paid every week, you working 2 weeks, a month without seeing a check. Okay, but let's look at this. You have to pay money for gas. You're paying money for food at work. You're paying money, you know, for clothes, your dry cleaning bills, you know, to go back and forth to work. You know, you're paying money for resources that you may need to buy for your job. Okay, so just imagine all the money that's actually coming out of your pocket before you even get paid a check. Okay, so that earned income is not enough. That's why people that work never become wealthy, never become rich. It's not going to happen unless you start utilizing a couple more types of income. Okay, like I said, this is for entertainment purposes only. But you have to realize that there are two other sources of income or kinds of income that they don't teach us this in school. I mean, you would think that, you know, you go to school, you know, that after you graduate from high school, you'll learn financial education. ATL, what's up in the house? What's up, C? Khadija, nice to see you again. Nice to see you in the house again, in the garden. Okay? So, you know, we got to have more than one source of income. And that source of income, if it's earned income, of course, that's our job. But we got to have a couple more. And so the next one that you need to have is portfolio income. And that's, I think Jason, he probably just alluded to that by investing in Fidelity and Vanguard with index funds. You have to have that. You know, me myself personally, I'm looking at, I do dividend stocks and growth stocks, but right now, I'm not really touching the stock market right now because remember, it said S&P 500 at 3,000 points. I mean, that's the highest it's ever been. They projecting the Dow Jones to get to like 28,000 points. Right now, I'm gonna sit on the sidelines for this one. Okay, if I'd have got in 2008, 2009, I'll be sitting pretty right now. Okay, but you know, like I say, it's what goes up must come down. It's the great time for those who've been in since 2008. They're experiencing a lot of profit, a lot of good times. All right, those that are just getting into this investment game and trying to understand it, you know, look up what they mean by market capitalization to GDP. And what that tells you is, you know, the value of the market in comparison to gross domestic product. And that's, you know, all of the goods and services produced in the country versus the market capitalization of the whole stock market. And if there are some discrepancies with that, then it tells you when's a good time to be in the market and when's not a good time to be in the market. That's the Warren Buffett indicator, which has been proven year after year, decade after decade. And all it's basically saying is, you know, if the market cap to GDP is over 95, over 100, you know, the market is overvalued. If it's over 100, the market is overvalued. And you probably want to sit on the sideline. Or if you have the capital to, you know, to invest, then do that. But if you're just not getting in, you know, those who are trying to build wealth, you know, you want to get in at a good time. Nobody's Nostradamus. You can't, you know, you don't know when it's going to happen. But there are indicators out there that can kind of give you a good idea, you know, because like I say, history always repeats itself. Okay? Do I day trade? Now, I don't day trade, but like I say, there is a difference between investing and trading, and there are different type of trading. Now, I would definitely encourage, you know, and thank you, nephew, for saying that, because I want to get into that. That can also be another form of income, and I was going to get into that. That basically can go into, and I don't want to put trading in the same context as the portfolio income. Right? Because you don't want to gamble when you're investing. So the two types of income that we discussed so far, we got the earned income, which is your job. You have the portfolio income, which is when you're buying stocks, you're investing in dividend stocks, you're investing in bonds, treasury bonds, municipal bonds, corporate bonds. Remember, these are things that are safe money havens where you're not losing. Okay, so that alone is comfortable to have when not only are you going to work and saving money, because remember, it just can't save. I got to reiterate, just putting your money in a savings account is not going to be enough because of inflation, because of banks don't give you rates that are comparable to a living wage once you retire. So if you're just saving your money, you're going to lose. It's like burning it. Okay, and so when you talk about the Federal Reserve lowering interest rates, okay, for those that are, you know, that are rich and wealthy, that's great news for the Federal Reserve to lower interest rates. AZ in the house, how you doing, sweetie? Okay, Jamaica, all right. So you have to make sure that you increase your financial knowledge and increase your financial education. T, what's up? Because if not, just that savings account is not going to do it. And like I said, if you seen my video earlier, we talked about how, and think about how cognitively dissonant we have to be as a nation to put in money. Daughter of the Most High, much love, much love. Thanks for joining me in the garden. You know, right now we're talking about multiple streams of income. How we're going to have to make sure that we don't depend on just one source of income. Like I say, we all have a job. Okay, we all have a job. Thank you so much. And that earned income is the first type of income that we're talking about. We all have a job, and paying yourself first. And that's why I say, think about your earned income when you get it. Matter of fact, do something one day. Figure out weekly, bi-weekly, monthly, how much you spend pertaining to your earned income. Meaning, gas money weekly, clothes, dry cleaning clothes, food and lunch. All right, resources and materials that you have to buy. Add up all that throughout the week. Now remind you, you're not going to be getting paid every day, but add up all of that. That tells you how much your money of your earned income is already out your pocket. No doubt, Marcus. All right? And so that tells you right there that when you get your check, you can't say this is the check that I've got of what I've earned. That ain't what you earned. I mean, you got to think about it. You got to think about your earned income like a business. You got to look at it, like we talked about earlier, about assets and liabilities. If you spending more than you bringing in, then that's a liability. So now what you have to do as soon as you get that check, we talk about it all the time, family, you got to pay yourself first. Pay yourself first when you get that check. And if you're young, pay yourself more. All right, and if you up in age like myself and older, we have to definitely increase our streams of income, because like I said earlier, we have to be kind of crazy to be putting money into pensions and Social Security, and they tell us that in 2035 Social Security be gone, or that in 20 years multi-employer pension plans may be depleted. Huh? Now, what you have to tell yourself and ask yourself, like what happened in 2008, when the banks, quote unquote, bellied up and overspent, when the mortgage companies, put out all those subprime loans, the government didn't tell them that, okay, well, you guys are just depleted. What happened? They bailed them out. How they bailed them out? By just printing more money from us, making us pay for it. You did? Because that's what they should have done. That's what they could do with Social Security. That's what they could do with our pensions. And remember, they're not doing us a favor, because remember, this is money that when you look at your check every 2 weeks or every month, it has a Social Security tax coming out. It has a Medicare tax coming out. It has that FICA tax coming out. Okay? And so, and not only that, then your pension, your 401k, Social Security. So, I mean, that's why we have to make sure we eliminate the minutia stuff that you see on the television, illegal immigrants, detention centers, R. Kelly's, all this kind of crap. That's not important. You have to make sure that we understand that, working for a company in a capitalistic nation is not going to get you to where you need to be. Earned income, you better pay yourself first with that earned income. Secondly, you need to produce and try to get yourself portfolio income. And what's that? Start investing in dividend stocks. Start increasing your knowledge about dividend stocks, increasing your knowledge about bonds. Like I said, 3 types of bonds: municipal bonds, corporate bonds, and U.S. Treasury bonds. Okay? Don't just put your stuff in the bank. And guys, I ain't got my glasses on, and I'm coming live from my phone, family. And then as soon as the comment come up, they go down. It goes away. Okay? So don't do that. It's never too early to start. It's never too late. Okay? And if you're in high school, Man, like I used to tell my students, until confess, I tell them get a job and pay yourself first. RJ, diversification is the key. All right, and we talking diversification not just in the portfolio sector of your income, but in every sector. In your earned income, like I say, pay yourself first. In your portfolio income, make sure you have bonds, make sure you have stocks, make sure you have dividend stocks, make sure you have index funds. And like I said, right now, if you've been in it a while, it's a great opportunity. You've made a lot of money, right? But make sure that you utilize stop losses. And if you don't know what that is, I mean, if you have a portfolio with stocks in it, and you know that it's going to crash, don't allow your money to just go. Don't allow yourself to lose 30, 40, 50% of your portfolio when you can utilize something, what they call a stop loss. All right? To give you an example, you got Ford stock and it's trading at $10. Well, we get some news that all of a sudden it's going to crash, and you have an indication because you're doing your research that it's going to crash, then you need to put a stop loss on that and say, I'm going to make sure that that Ford stock don't go no lower than $10 or $9.50. And then, of course, you just hedge it against the loss. And so if it does crash to $3, you sold it at $9 and you hedged against that loss. And so these are different type of tools that you need to educate yourself on if you want to maintain a portfolio source of income. Remember, the earned income, you got that in the bag. You get up every morning and do that. The portfolio income, it requires some education. It requires you to, increase your financial education. Okay? Stocks, bonds. All right? And then the third source of income is, I like to call that passive income. Okay? And what's passive income? Passive income would be money that's coming in and you're not working for it. And how do you get passive income? The greatest way to get passive income, family, is to invest in real estate. All right? Real estate. That's the best way to gain passive income. So let's look at this for a minute. And how can you get passive income? You got to get that credit tight first, family. That's real. That's right. Yeah, artificial intelligence I think that's something, family, that you probably want to look into investing in that sector when it comes time. And also, fathers, investing. Family, there's something called good debt and bad debt. And if you're just joining me, family, in the garden, we're talking about 3 types of income that you need to utilize in order to make sure your wealth and your net worth grow. And that's earned income, which you work for, portfolio income, which you invest in stocks and bonds, and then passive income, which you can get from investing in real estate, or if you have an opportunity to start selling something, like a business or something, where it's bringing money in. Passive income is that income where it's definitely an asset, and it's not a liability. Because remember, this is money that's coming in. Gold and silver, you ask yourself the question, is it an asset or a liability? Gold and silver, okay? Now, what you can do, you can hedge against liability with gold and silver, but let's keep it 1,000. If you buy an ounce of gold for $1,500, right? And then 2 months from now, the price of gold drops and now your gold is worth $900. Is that an asset or liability? You dig? And so that's what I'm saying. I'm not telling, because that's great diversification. Let's not get it twisted. But me personally, I'm into liquidity, and I'm into, is it an asset or is it a liability? And you judge that based on your time frame and based on your own diversification and based on your own goals. Yes, I'm gonna own some gold, soon. But is this something I'm worried about now? No, because remember, I remember when gold was like $700. Now it's what, $1,500 an ounce. Now I sit on the sidelines for this one. Yeah. There's more you can do in transport than driving. That's a great point. But like I say, driving, increasing your income by having multiple sources of earned income, which will be, which I'm a big advocate of, that ride share, driver share, that Lyft and Uber. Man, think about it. You know, you have a good record, you have insurance, all that. You have a vehicle, you have time. Man, drive for Lyft or Uber a couple days a week, or especially if you're in the city, and all that money right there, bam, that can go towards your portfolio money. You understand how it goes? And so, multiple streams of income, family, is going to be imperative, because, like I said before, family, Social Security and pension plans, yes, it's good to make sure that you're going to have that. But how sure and how certain are we that it's going to be there when they already tell you that it may not be there? And so that's what I'm saying. You know, increasing this type of knowledge, I think it's just a great opportunity. And it's something that not only can you increase your knowledge, you can increase your children's knowledge, your spouse's knowledge, your boyfriend, your family's knowledge on this. All right? It's not something that can be, you know, I think it's something that every one of us can be able to take advantage of. And I'm telling you right now, the market right now is overvalued. The real estate market is overvalued. But understanding what money is a great thing. And for example, debt. A lot of people think that money ain't debt. Money is debt. And how is money debt? If you have great credit, right? Think about the scenario before I get out the garden, family. If you got great credit, what do you think would be a smarter investment? Go and get a $40,000 car, buy you a $40,000 car, or go get your $40,000 loan, cash, and invest in real estate and buy you a couple of properties, and then see how that money coming in every month. But the car loan that you're not going to receive from the bank, but you're just going to be told you can go buy this $40,000 vehicle, guess what? You're going to be paying a note every month. Is that a liability or is it an asset? The $40,000 loan you got and bought those couple of properties that you're getting money from every month, is that a liability or is it an asset? You dig? And so that's what I'm talking about. So that's why tonight, I just want to come. And like I said, if you didn't get a chance to read the book, Rich Dad, Poor Dad, great book called by Robert Kiyosaki. The title of the book, family, is called Rich Dad, Poor Dad. Great book. And in that book, it gives those type of scenarios, because it gives you a clear understanding. I mean, if you got great credit, think about it, and you have a vehicle that works, why go buy a new vehicle when your credit you can already be paying for this vehicle 2 or 3 years? You got great credit. Instead of go get another loan for a vehicle, get a loan for an asset. Get a loan that when this market crash, you got capital on the side waiting. So you get some great dividend stocks. So you're gonna be able to get some great index funds. No doubt, Brandon. It is a great book. Okay? And so if you didn't get a chance to watch my video when I mentioned the difference between capitalism, socialism, and communism, check that video out, because it's important that you understand why the system that we're in is called capitalism. Without capital, capital, money, how you gonna stay in this game? Hey, yeah, Kiyosaki, thank you, Ryan. Okay, and like I say, he's on YouTube as well. All right, but great book, Rich Dad Poor Dad. And so, like I say, fam, I'm just glad you got the chance to stay with the garden with me tonight. 3 sources, 3 kinds of income you need to probably take advantage of. Remember, earned income, that's everyday work. And remember, change your mindset when it comes to your earned income. Please don't get up and go to work every day like it's a chore. Look at it like this, because remember, you don't get paid every day. So right away, you know that the person that's the CEO of the company or the company owners, they get paid every day on our energy, on our energy every day. But you go to work, come home, go to work, come home, go to work, come home. And guess what we do, family? It become a bread and circus situation, because it's not normal to go to work every day and not get paid. You dig? I mean, think about our kids. I mean, when we have them do chores at home, I mean, you know, they want something in return. It's not normal to do work every day and not want something in return. And so what do? Man, I need to come home and, man, let my hair down. No pun intended. So what I do, man, go to the movies or go buy a video game or go to a professional sports game. And what is that doing? That's a liability because it's money, it's cash flow leaving. So what do? Flip the script on your mindset when it comes to work and say, okay, hey, these 2 weeks, I'm paying myself first, and I'm gonna make sure this work I did, I'm gonna make sure I can see it. We don't see the work if every time we get paid we just spend the cheddar. Don't let them do us like that, especially when we know that they're already tripping on Social Security and our pension plans and 401ks. Remember, family, when this market crash, your 401k is gonna be affected by it. And so I would definitely make sure that you contact the people that your 401k or 403b is being managed by, and find out what it is that your funds are associated with, so you can start trying to reallocate. You can do that. That's your money. And remember, the hedge fund manager that's over your account, which on your 401k, they get paid fees every month. They getting paid. So make them work for your money. Don't just give them your money and then you don't know. You get a balance, you get a statement every month. You should, you're supposed to. So you need to know what those mutual funds are tracking. And so when we hear about this market crash, then you'll be ready. All right? All right, family, I'm finna get on out here, family. Thanks for joining me. In the meantime, between time, may the Most High Society bring you joy and being with us out of 5,000.